Greetings to my beloved lecturer and my friends. Today I'm going to present about IFRS 2 that was share-based payment. Share-based payment was issued on 19 February 2004 in Malaysia. The reason to create the company's engage is to share-based payment is to retain the share they retain the staff and encourage the employment to be committed to the higher performance of the company. The second reason is to reduce agency costs and encourage the directors and staff to pay more attention to increasing shareholders' value in a company and a board of directors. Furthermore, the definition of the share-based payment is an agreement between entity for another group of entity or shareholders or any group to provide goods and services according to the payment of the share prices or share value. Okay. The next is the three types of share-based payment. First share-based payment is equity settle. Equity settle is a transaction is equity settle where the equity receive goods or services that are settled by issuing equity instrument. For example, it is a share option. The second one is cash settle. Cash settle is equity receive goods or service by equating a liability to transfer cash other asset to the supplier for amount that are based on the price or value of the entity share. Is choices of equity settle and cash settle transaction in which the entity receives goods or services and the terms of arrangement provided either the entity of supplier of those goods or services with a choice of whether the entity settle the transaction in cash or by issuing equity instruments. In addition, the scope of the share-based payment is transaction with counterparties acting as a shareholders rather than the suppliers of goods and services. Other than the second scope of the share-based payment is transaction in which a share-based payment is made in exchange for control of a business. Thirdly, the last scope in the share-based payment is transaction in which contracts to acquire non-financial item in exchange for a share-based payment are in the scope of the financial instrument standard. Moreover, there is a three main heading disclosure of share-based payment. The first one is they understand the nature and extent of share-based payment transaction during the period. Second one is understand the fair value of equity instrument which have been granted the period was determined. The third one is understand the effect of expenses from share-based payment transaction in the period. Lastly, there is some exemption of the share-based payment, that is purchase of goods within the scope of IAS 32 and 39, issue of share to acquire the net asset in a business combination. Third one is purchase of own share from employee on the fair value of shares.
Okay, very good evening to my dear friends and my dear lecturer. Just now, one of my teammate explained about the half part of share-based payment. Now I'm gonna explain another half part of share-based payment. Okay, let's see. First of all, vesting conditions. Okay, vesting conditions other than market condition may not be considered in measuring fair value at the grant date of a share-based payment arrangement. Instead, they should be taken into account by adjusting the number of equity instruments and entity expect to issue under the share-based payment arrangement. Vesting conditions are therefore highly relevant in accounting for share-based payment. Okay, the second thing I would like to explain about the recognition principles. International Financial Reporting Standards 2 requires an expenses to be recognized the goods or services received by a company. The corresponding entry in the accounting records will either be a liability or an increase in the equity of the company depending on whether the transaction is to be settled in cash or in equity shares. Goods or services acquired in a share-based payment transaction should be recognized when they are received. In the case of goods, this is obviously the date when this occurs. However, it is often more difficult to determine when services are received. If shares are issued that vest immediately, then it can be assumed that these are the consideration of part services. As a result, the expenses should be recognized immediately. Alternatively, if the share-based payment vests become an entitlement in the future, then it is assumed that the equity instruments relate to future services and recognition is therefore spread over the vesting period, that the period during which specified conditions are to be satisfied. Okay guys, the next thing we will see the measurement. Measurement was divided by 4 parts, that is historical cost, intrinsic value, minimum value and fair value. Okay, let's see one by one, and the first of all is historical cost. In jurisdictions where legislation permits, entities commonly repurchase their own shares either directly or through a vehicle such as a trust, which are used to fulfill promised grants of shares to employees or the exercise of employee share options. A possible basis for measuring a grant of options or shares would be the historical cost of its own shares that entity holds, even if they were acquired before the award was made. For share options, this would entail comparing the historical cost of own shares held with the exercise price of options granted to employees. Any shortfall would be recognized as an expense. Also, presumably, if the exercise price exceeded the historical cost of own shares held, the excess would be recognized as a gain. At first sight, if one simply focuses on the cash flows involved, the historical cost basis appears reasonable. There is a cash outflow to acquire the shares, followed by the cash inflow when those shares are transferred to the employees, with any shortfall representing a cost to the entity. If the cash flow related to anything other than entity's own shares, this approach would be appropriate. But when this analysis is applied to the entity's own shares, the logic breaks down. The entity's own shares are not an asset of the entity. Rather, the shares are an interest in the entity's assets. Hence, the distribution of cash to buy back shares is a return of capital to shareholders and should therefore be recognized as a decrease in equity. Similarly, when the shares are subsequently reused or transferred, the inflow of cash flow is an increase in shareholders' capital and should therefore be recognized as an increase in equity. Okay, the second part is intrinsic value. An equity instrument could be measured at intrinsic value. The intrinsic value of a share option at any point in time is the difference between the market price of the underlying shares and the exercise price of the option. Often employee share options have zero intrinsic value at the date of grant. Commonly, the exercise price is at the market value of the shares at grant date. Therefore, in many cases, valuing share options at their intrinsic value at grant date is equivalent to attributing no value to the options. However, the intrinsic value of an option does not fully reflect its value. Options sell in the market for more than their intrinsic value. This is because the holder of an option need not exercise it immediately and benefits from any increase in the value of the underlying shares. In other words, although the ultimate benefit realized by the option holder is the option's intrinsic value at the date of exercise, the option holder is able to realize that future intrinsic value because of having held the option. Thus, the option holder benefits from the right to participate in the future gains from increase in the share price. In addition, the option holder benefits from the right to defer payment of the exercise price until the end of the option term. These benefits are commonly referred to as the option's time value. For many options, time value represents a substantial part of their value. As noted earlier, many employee shares options have zero intrinsic value at grant date, and hence the option's value consists entirely of day or of time value. In such cases, ignoring time value by applying the intrinsic value method at granted date understates the value of the option by 100%. And the board concluded that in general, the intrinsic value measurement basis is not appropriate for measuring share-based payment transactions because omitting the option's time value ignores a potentially substantial part of an. Okay, the third thing is minimum value. Share option could be measured at its minimum value. Minimum value is based on the premise that someone who wants to buy a call option on a share would be willing to pay at least, and the option writer would demand at least the value of the right to defer payment of the exercise price until the end of the option's term. Therefore, minimum value can be calculated using a present value technique. For a dividend paying share, the calculation is first the current price of the share minus the present value of expected dividend on that share during the option term. If the option holder does not receive the dividends, minus the present value of the exercise price. This is the calculation. Minimum value can also be calculated using an option pricing model with expected volatility of effectively zero, not exactly zero, because some option pricing models use volatility as a divisor and zero cannot be a divisor. The minimum value measurement basis capture part of the time value of options, being the value of the right to defer payment of the exercise price until the end of the option's term. It does not capture the effect of volatility. Option holders benefit from volatility because they have the right to participate in gains from increases in the share price during the options term without having a bear or the full risk of loss from decreases in the share price. By ignoring volatility, the minimum value method produces a value that is lower and often much lower than values produced by the methods designed to estimate the fair value of an option. And the board concluded that minimum value is not an appropriate measurement basis because ignoring the effect of volatility ignores a potentially large part of an option's value. As with intrinsic value, measuring share-based payment transaction at the option's minimum value would fail to represent those transactions faithfully in the financial statement. Okay, the last part of measurement is fair value. Fair value is already used in other areas of accounting, including other transactions in which non-cash resources are acquired through the issue of equity instruments. For an example, consideration transfer in a business combination is measured at fair value, including the fair value of any equity instruments issued by the entity. Fair value, which is the amount at which an equity instrument granted could be exchanged between knowledgeable, willing parties in an arm's length transaction, capture both intrinsic value and the time value and therefore provides a measure of the share option's total value, unlike intrinsic value and the minimum value. It is the value that reflects the bargain between the entity and its employees, whereby the entity has agreed to grant share options to employees for their services to the entity. Hence, measuring share-based payment transactions at fair value ensures that those transactions are represented faithfully in the financial statement and consistently with other transactions in which the entity receives resources as consideration for the issue of equity instruments. Therefore, the board concluded that shares option or other equity instrument granted should be measured at their fair value. Okay, the next part is modification. The determination of whether a change in a terms and conditions has an effect on the amount recognized depends on whether the fair value of the new instruments is greater than the fair value of the original instruments, both determined at the modification date. Modification of the terms on which equity instruments were granted may have an effect on the expenses that will be recorded in International Financial Reported Standard 2 clarifies that the guidance on modifications also applies to instruments modified after their vesting date. If the fair value of the new instruments is more than the fair value of the old instruments by reduction of the exercise price or issuance of additional instruments, the incremental amount is recognized over the remaining vesting period in a manner similar to the original amount. If the modification occurs after the vesting period, the incremental amount is recognized immediately. If the fair value of the new instruments is less than the fair value of the old instruments, the original fair value of the equity instrument granted should be expensed as if the modification never occurred. And the final part of the share-based payment is settlement and cancellation. The cancellation or settlement of equity instruments is accounted for as an acceleration of the vesting period and therefore any amount unrecognized that would otherwise have been charged should be recognized immediately. Any payments made with the cancellation or settlement up to the fair value of the equity instrument should be accounted for as the repurchase of an equity interest. Any payment in excess of the fair value of the equity instruments granted is recognized as an expenses. The new equity instruments granted may be identified as a replacement of cancelled equity instruments. In those cases, the replacement equity instruments are counted for as a modification. The fair value of the replacement equity instruments is determined at grant date, while the fair value of the cancelled instrument is determined at the date of cancellation, less any cash payment on cancellation that is accounted for as a dedication from equity. Okay, finally we reach the conclusion. The disclosure was the nature and extent of share-based payment arrangements that existed during the period. How the fair value of goods or services received or the fair value of the equity instruments granted during the period was determined. The effect of share-based transaction on the entity's profit or loss for the period and on its financial position. Okay guys, I hope you all will satisfy by me and my teammate presentation. Thank you.